Welcome to the Babalian Money Show. So, you're ready to start investing, but where do you even begin? Stocks, mutual funds, ETFs. It all sounds so complicated. Don't worry, by the end of this video, you'll understand exactly what these are and which one might be right for you. We're going to break it all down, simple and clear, so you can feel confident on your investing journey. Let's get started. First up, let's talk about individual stocks. When you buy a stock, you're buying a tiny piece of ownership in a single company. Think of it like this. If you buy a share of Apple, you officially own a very small slice of the company that makes your iPhone. The big appeal here is the potential for high rewards. If that company does incredibly well, the value of your stock can shoot up and you could make a lot of money. However, the flip side is high risk. If that same company performs poorly, your investment could lose a significant amount of its value or even go to zero. It's like putting all your eggs in one basket. It can be exciting, but you need to be prepared for the volatility and do a lot of research on each company you invest in. Next, we have mutual funds. A mutual fund is like a big pot of money collected from many different investors. A professional fund manager then takes all that money and invests it into a variety of stocks, bonds, and other assets. This is known as active management because someone is actively making decisions about what to buy and sell. The biggest pro? You get instant diversification and a professional managing your money, which is great for beginners who don't want to pick individual stocks. The downside: these managers don't work for free. Mutual funds typically have higher fees, called expense ratios, which can eat into your returns over time. Also, you can only buy or sell mutual fund shares once per day, at the price set at the end of the trading day. So, they aren't as flexible as stocks. Now, let's look at ETFs, or exchange-traded funds. Many people think of ETFs as a hybrid, combining the best features of both stocks and mutual funds. Like a mutual fund, an ETF is a collection of many different investments, so you get that wonderful diversification. You can buy an ETF that tracks the entire S&P 500, for example, which means you're instantly invested in 500 of the largest U.S. companies. But here's the cool part. ETFs trade on the stock exchange just like individual stocks. This means you can buy and sell them throughout the day, whenever the market is open, giving you much more flexibility. On top of that, most ETFs are passively managed, meaning they just track a specific index. This results in much lower fees compared to actively managed mutual funds. Low fees and easy trading make them a fan favorite. So let's put it all together. For fees, individual stocks have commission fees when you buy or sell. Mutual funds have the highest fees because of active management. ETFs generally have the lowest fees. In terms of flexibility, stocks and ETFs are the winners, as you can trade them all day. Mutual funds are the least flexible, with only one chance to trade per day. And for risk, individual stocks are the riskiest. Mutual funds and ETFs are much less risky because they are diversified across many different assets. You're not relying on just one company to succeed. For most beginners, ETFs offer a fantastic starting point because they provide a simple, low-cost way to get a diversified portfolio. No matter which path you choose, the most important lesson is diversification. Spreading your money across different investments is key to managing risk and building long-term wealth. Hopefully, this clears things up. Investing doesn't have to be a mystery. Thanks for watching. If you found this guide helpful, please hit that like button and subscribe to the Babalian Money Show for more simple investing guides to help you build your financial future. See you in the next video.